I want to talk about that issue of banking concentration a little bit later. But first, I'm curious where you place the blame for how we got to this point. Obviously, the management of Silicon Valley Bank itself made some very bad and, to my mind, almost inexplicable bets on interest rates. And maybe you can explain to the audience what was at issue there. But regulators apparently had seen some of these problems and had issued warnings to some degree. Is this a management failure, a supervisory failure, or both?
So David, you asked a really interesting two-part question, and I want to sort of delve in on both parts of your question. I'll take the second part first, and then I'm going to go back to the first part of how we got there. So I'll do it in reverse order. It's very clear to me now that we've seen more of the evidence, and we'll continue to see more and more evidence, but we had two different hearings, a Senate hearing and a House hearing this week with the regulators. So now we have more transparency in what was going on at the bank and what was going on in the supervisory community. And it's clear to me that the supervisory community identified the risk. They had elevated it to the bank's management. Bank's management did not follow through, but I'm also going to criticize the regulators or the on-site supervisors. The on-site supervisors should have not allowed bank management to ignore this. I know very well that when I ran a bank, our on-site supervisors, when they issued a MRI in bank terms, which is a matter needing immediate attention or anything like that, they made sure that bank management was dealing with it in a very speedy fashion. And the on-site regulatory team has enormously broad powers to shut down banks, to go to Washington and really impose very stringent restrictions on a bank. As you know, we've seen them impose asset caps on banks. They can threaten to shut you down. So there was a management problem here. There was an on-site supervision problem. There was an oversight regulatory problem in the San Francisco Fed. But let's go back to how we got here, because I think it's really important to understand how we got here. We have to go back 3 years ago. We have to go back to March of 2020, the beginning of COVID. We were in an environment where if you would pick up any newspaper, if you talk to anyone about what's going on at the Federal Reserve or what's going on in interest rate policy, all of the conversation would be about, will we ever have inflation again in the United States? At the time, we had a zero interest rate policy, and we had the Federal Reserve buying securities, trying to create tighter interest rates, trying to create some tightness in the economy to create inflation, because the Federal Reserve has a dual mandate of 2% inflation and full employment. Then lo and behold, we get into a pandemic, and the government steps in and starts stimulating the economy by providing money to small businesses, providing money to workers to make sure they can live their lives. It's justifiably so. But we continue down multiple rounds of stimulus to the point where the US consumer can no longer spend that much money, because if we take ourselves back to that period of time, the only place the US consumer could spend money was at the grocery store or anything that the United States Postal Service, UPS, or Federal Express could deliver to you. You had no other outlet to spend money. So you weren't needing to borrow any money from the banks. The banks had absolutely no loan growth during this period of time. No one was out buying a house. No one was out charging on their credit cards. No one was using the natural loan demand that exists in the system. And all of a sudden, the banks were being flooded with deposits. Money supply grew well over 30% during the pandemic. And so banks are sitting there with all this money on their balance sheet. They don't know what to do with it. There's no natural loan growth. So they start buying US securities because it is the least risky asset they can buy. And then we get to literally a year ago. It was a year ago last March, and we have inflation. And in the beginning, the Federal Reserve talked about the inflation not being permanent. They talked about it being transitory. They talked about it being, the immediate effect of restarting the economy, putting people back to work, getting the supply chain up and going, and then it would quote unquote be transitory and it would disappear quite quickly. Well, the Federal Reserve was wrong. That inflation was not transitory. So the Federal Reserve went on an interest rate raising cycle that has really been quite extraordinary. We went from 0% interest rates in the United States to basically 5% in the course of 12 months. So any bank that bought any Treasury securities, which will mature at par because they are the full faith and credit of the United States, they are on a mark-to-market basis. Those securities are going to lose them money if they have to sell them right now. So banks ended up in this position because of what was happening because of stimulus in the economy.